Hello traders, Gary Wagner here, just before 10 o'clock in Honolulu, 4 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands, 24th day of June, 2016, and this is a special edition of the Gold Forecast, our weekend review, and what a week we have seen. Of course, referendum vote has been cast, and Britain is leaving the European Union. That sent tremors and shockwaves throughout the entire financial market. Beginning yesterday, we profited handsomely from that move. Of course, we'll talk about the trades that we did put on yesterday, as well as my outlook for what we should see over the next couple of weeks. But there's absolutely no doubt we are witnessing the beginning of something that will have ripple effects in the financial markets for the weeks, months, possibly the years to come. Gold up substantially, up about $62 as we look at it now, $13.19. It traded to an intraday high of $13.60, and the low on the day was $12.50. So in a period of approximately 3 hours, we witnessed one of the most dynamic rallies this trader has ever seen in the gold market. An incredible upside move in gold. Of course, there has been a rush to safe haven investments, US dollar being the other safe haven investment investors seem to be gravitating towards, so that when we look at this $63 rise, we really have to take into account the big picture, and that is what the dollar is doing. I've just put up the Kitco Gold Index. As you can see, when we look at gold at $13.18, that puts it up almost $90 on the day, but you've got to take away that really strong US dollar. We will take a look, of course, today at a dollar chart as well as a British pound chart, but you have to subtract almost $30, $28.10, to give us that net change of $62.60. An incredibly impressive move in gold. There's absolutely no doubt that the most recent moves in gold have provided us at the Gold Forecast with exceptional market moves to profit and be rewarded quite well for our trades. We're up considerably on the year. More importantly, these last couple of trades, what we did yesterday, as well as going into the first part of this rally, were superlative trades. And to give you an example of what we're talking about, I draw your attention to this daily chart. Of course, as the market came down and we hit these bottoms at 1200, I was hesitant to really get involved or take a stab at the market until we had pretty concrete evidence that we had weathered the correction and that what we were looking at was the beginning of a major rally. So as this market started moving up, we missed this one large $30 spike. And that occurred on a Friday. And the reason I remember that is because Sunday here in Hawaii, Monday overseas, we actually initiated the first of 3 trades that we've done over the last couple of weeks. We went long the market at about 1245. We trailed our stops up, and as this market came up, it actually on an intraday basis touched at about 1320. Our initial target was about 1308, and that was a Fibonacci-based number, as well as matching recent highs, all-time highs that we saw last year. We were able to get out of that trade at roughly 1294, very close to 1300. At that point, we sidelined, and we sat on the side for this last week until yesterday. And to give you an idea of what we saw yesterday, we really have to move from a daily chart to an intraday chart. So traders, this is what we were looking at. Let me go get my pointer up. First, you can see this is the daily chart we have been looking at. I have been under the basic assumption that we are now out of a corrective wave 2. We've moved into an impulse wave 3. And in that impulse wave 3, we correctly identified the first component, the first rally, that one of 3. In at, as I said, 1245, out just below 1300. That began this corrective action that we saw, which I believe was a small wave 2. And so what we really needed to determine was at what point that corrective wave would end and we'd move back into rally mode. And traders, if you recall from yesterday's show, I actually suggested putting a price order in to buy gold at $12.50 or better. Now, we were flat the market. We were awaiting some sort of technical confirmation that, in fact, this correction that we had been experiencing was over. As the votes began to be counted, we saw some activity really start to spark in global equities markets, as well as the dollar and gold. Gold coming off of these lows at about $12.51. And as it moved up and broke above, or just before it broke above, I should say, when it was trading between 1268 and 1270, I realized something was up. And I didn't really need to look at the news because the market itself was telling me that the assumption made by the vast majority of traders as to the outcome of the referendum vote was wrong. And we saw gold begin to get bid up. And so I put out an effective buy recommendation. Traders taking that call got in at 1268. Again, this is an hourly chart. So over the next hour, we watched the market go from about 1270 up to an intra-hour high of above 1300. And in fact, when it started to breach 1300, I realized that we had an environment that could be really, really conducive to making some extreme profits on yesterday's activity. So I sent out another trade recommendation to add to that position. So we were long at 1270. We were then long another leg of this trade at 1300, and the market continued to fly. And the key to what we were looking at is as follows. This market moved dynamically up. At the top of this market, this was an entirely long green candle. And we saw the market actually come in and test 1360. But it started to come down with a fury. And I realized that we were witnessing some strong profit taking. Although I don't believe the move is over, I felt as though this leg of the move has really reached its maximum performance. I sent out a special trade alert as the market was coming down and told our traders to exit all long positions. Traders got out at 1340. Market closed 1321 today, so about $20 below our exit point. We will go into the weekend flat with no active trades. We've got this exceptional trade under our belt in which we took about $120 out of the market, and that of course would be based on two contracts. One contract we got in, as I said, 1270 out at 1340. The other one we got in at 1300 and out at 1340. An exceptional trade under our belt. But that was yesterday and today. What do we think the market will do next week? And to help us address and answer that question, the best technique I know is to create a basic fib extension, because if we do some very, very straightforward Elliott wave modeling, in essence, what we would look for is this. Wave 1 is always going to be our benchmark wave. One of the most golden rules in Elliott wave forecasting is that wave 3 cannot be the smallest of any of the impulse waves, waves 1, 3, and 5. Now we clearly have the wave 2 conclusion at hand, so we know where to track the beginning of our wave 3, and then we can base our upside target for this next rally based upon the move that we saw in wave 1. Now, based upon that, I've created a basic fib extension. Let me go ahead and get my pointer back up here, 1 second. And to do that, what we've done is we have really set our first set of variables for this rally. We've then begun our extension here at these lows at 11.99, And this arrow signifies a one-to-one relationship, and that's what this is. In other words, if gold moves in this next rally, and that rally is equal to the rally we just had, we should see gold top out somewhere around 1373. And so I really believe that next week we will see a continuation of this upside trend in gold, but I think that it could go a little bit higher than that. If you recall from the beginning of this year, when we first started seeing this market move up, I did some genuine wave forecasting for what I believe is this current wave B that we are in. That's the major count, and said that I believe we will see gold move to 14 to 1450. At that point, I believe that many of my subscribers, as well as those listeners at YouTube and those that watch our show a little bit more casually, thought that that was a fairly bold statement. As we look at gold at 1320, it doesn't seem so far-fetched. Last week, I made another one of those grandiose statements and said that if, in fact, the UK passes the referendum to exit the European Union, we would see gold fly past 1300 and witness a 500-point plus drop in the Dow Jones Industrial Average. That is exactly what we saw occur last night as well as today. And here's where it gets interesting, because if in fact what we're looking at in terms of our Elliott wave count is not a one-to-one and it's a more standard 1 to 1.61, because that is the typical kind of extension you will see, that would actually take gold prices to 1447. Now, I don't believe that will occur in a single rally, although today's parabolic move is really setting the wheels in motion to see that follow through next week. We will look to regain our long stance in the market and enter another trade at the beginning of next week. I simply want to see where the dust settles over the weekend, if we're going to get any kind of backfill and profit taking before returning to rally mode, or if we're just going to continue on this parabolic move up. So as I said, what are my targets? Low-end target right now, 1380. High-end target, 1447. So traders, as we talked about at the beginning of this report, gold had tremendous headwinds to overcome as it overcame a strong U.S. dollar. Dollar up about 2% on the day, 95.41. And to get a real sense or feel for what we saw today, I draw your attention to this chart I've just pulled up. Standard candlestick, but it is a 13-minute candlestick chart. And you can see exactly how strong this dollar was when you consider that it was trading at roughly 93 before statements came out, the votes began to be counted for the referendum, and it was clear that the assumption that the UK would not leave the EU was an incorrect assumption, and that traders got that wrong, dramatically wrong. Up until the votes started to be counted, you can see the market traded in a very narrow and defined range. But take a look at this spike that we saw from 93 up to 96.60, intraday high just above that, before settling at about 95.35 on the day. So traders, in as much as just prior to the counting of the votes yesterday, we had an extremely strong risk on environment. We saw the Dow Jones Industrial Average close over 18,000, but that was to be extremely short-lived, closing off over 600 points today to close at 17,399. In fact, Dow Jones Industrial Average futures were down 600 last night, so the writing was already on the wall. Standard & Poor's also tracking tremendously hard to the downside, off about 4%, 87, 88 points. You can see it's still actively trading as we are about 15 minutes from the effective close of Friday's trading activity. It is now 10:15 in Honolulu, Hawaii, 4:15 in New York, and the Standard & Poor's vis-a-vis the E-mini is trading at 2018, putting it off 86 points on the day. So this dramatic decline in not only European equities, but U.S. equities is quite evident when we take a look at this daily chart of the Standard & Poor's standard candlestick format. And you can see this dramatic decline. However, on a technical basis, what I find most interesting is the fact that although we traded below the 200-day moving average, we did effectively close above that. As I said last week, if we see a referendum pass, we'll probably see a 500-point drop in the Dow Jones Industrial. We certainly got that. I also said that that would probably present us with an excellent opportunity to buy U.S. equities, because I think that this kind of move is a knee-jerk reaction that is overcompensating for the possible effects or repercussions that we would see immediately from this referendum vote taking place. Most importantly, let's let the dust settle, but I'm looking at this market, if it holds above the 200-day moving average, as a buy rather than a sell. Now, all bets are off if we trade and effectively close below that. If we do, our next real target area is 1943. So traders, absolutely no doubt, we witnessed a tremendous, exciting week in the markets this week. Virtual meltdown in European equities, U.S. equities, a move run to safe havens like U.S. dollar and gold. We were presented with exceptional opportunities, and just yesterday alone on a single trade, we were able to profit in terms of percentage gains, about a 60% return on a single trade. And that, of course, was based upon entering the market at 1270, adding another position at 1300, exiting both those contracts at 1340. As you know, I am typically not a day trader. I am a trend trader, and I believe that the trend in gold has been evident. I have had that belief ever since we had confirmation of this market hitting a bottom early this year at about 1045 to 1060. We have been able to profit substantially as this market has run up, and our percentage profits at this point are exceeding 300% in terms of our return this year alone. More importantly, I'm extremely excited about the opportunities we will see over the next couple of weeks and months ahead. As you know, I have been on record looking for gold to move to about 1450. I put this out as public record when the market was trading at 11 and 1200 per ounce. And at this point, when we're looking at gold at 1320, it seems as though the light at the end of that tunnel, so to speak, is much more visible than when we first put out our model and forecast. Subscribers, I'm so glad that you've been able to work with us over this year, and I know that you have profited from these trades substantially. And as you know, my closing remarks to every show that I do is wishing you, as always, good trading. I can gladly report today that those wishes absolutely came true. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.